Good morning, traders, and welcome to the live stream. My name is Charles Gough. I come from a community called Piratetraders, where we are focused on the ES, the NQ, and how they move through the two-way auction process. It's been a crazy couple of weeks in the markets, that is for sure, but the markets are giving us some technical signals that we can use to have an edge. And I think we got some more of those coming up this week, so I wanted to take a few minutes here and walk you through how I see things, how I read things, and what I expect to happen next. Okay, so first and foremost, let's start by zooming all the way out and taking a look at the monthly charts. It's been a while since we took a look at the monthly charts, so they might give us some insights to carry forward. Okay, first things first. Let me just change the settings here because I don't want to see this on the monthly. Okay, so on the monthly chart, what we have is a trend down. Each month over the last 3 months is making lower highs and lower lows. Okay, that is a sign that the market is bearish and it is likely to continue lower. However, having this massive wick on this month's candle means that if right now, and I do mean this week, we can turn around and get this momentum up, this could potentially be the low. Now, it is too early to say that because we are still trending lower on the monthly, but that big of a wick on a monthly is often when the market reverses, so that's something to keep in mind. Let's zoom in and take a look at the weekly. See if the insights change at all. Again, same thing. We can see that we are trending lower on the weekly. We had a multi-week balance area in here. We broke out of it and we are still one time framing lower as far as the weekly is concerned. If today or anytime this week we can get above last week's high, that would change the momentum. We would no longer have momentum down, and that would start the momentum up to the opposite end of that weekly balance. But one step at a time, we are still one time framing lower on the weekly. And then lastly, we'll take a look at the daily chart. On the daily chart, we have just broken out of a smaller range. So this was a multi-day balance area. We broke out of that on the news from Trump that we were going to get a relief of the tariffs. The market then came back to the balance area high. It spent 2 days grinding around on that balance area high, and we're going to take a look at that on the market profile chart here in a second. But we spent 2 days balancing around in there, and then what happened? By the end of the day Friday, we broke higher. So the way I read this from a technical standpoint is that this was a break out of balance that came back to back test it. Finding support increases the odds that the market is now going to get a move, at least the size of the range of the balance area. So that should be able to get us up to this trend line that we have been monitoring on the daily time frame that has been smacking the market down, which will be somewhere above 5,600. Okay, so we're looking for the market over the days ahead to continue up into this resistance and then find out what happens there. If it gets smacked down there, that would be very bearish. If it's able to poke through, we could be heading up to all-time highs. Okay, so that's the bigger picture look at the market. Now let's take the market profile software. Let's zoom in a little bit. Let's get some more detail so that we can understand exact levels where the market is likely to do business and what we would expect to see at those levels. So first things first, the gap up this morning is no surprise to anyone. I predicted it at the end of the live stream on Friday because we spent the whole morning right on this balance area high trying to decide, are we going to fail and pull back in, or can we really break out? Are there really buyers for momentum to the upside? Well, by the end of the day, we had our answer. We closed up here basically at the previous day's high. So that was the market telling us we have that momentum. If we were going to fail, if we were going to head back down towards the lows, Friday was the time to do it. The fact that we closed up here near the highs on Friday was telling us we have momentum up. We have buyers. So it is perfectly natural to expect for there to be a gap up over the weekend with that momentum. So this morning, what we are paying attention to is what happens with this gap up. Okay, does the market open and immediately start to trade higher? That is what we call a gap and go. That is the most bullish scenario. Or does the market open, fill the gap, okay, but then find support around yesterday's high and turn around and head higher? That is a gap fill and go. Both of those very bullish, and we would expect continuation to the upside. And then the third potential scenario for today is that the market gets back to Friday's high. It gets back to 54.18, but it can't find support there. Then it would need to start to pull back into Friday's range. Now, this might sound a little confusing, but let me do my best to explain this. If the market fills the gap and it doesn't find support at Friday's high, it is not necessarily bearish, bigger picture. I would be willing to short intraday, but it would just be a very little bit of momentum to the downside. Because if we can't turn, now again, you need to understand the steps in the process for this to make sense. Step one was we broke out of the balance. Okay. That told us the market wanted to go higher. Step two was we spent 2 days confirming that we definitely do want to go higher. And that the solution to that was, yes, we do want to go higher. And now we're opening up with another confirmation from the market with the gap up this morning that we want to go higher. So with this many bullish things, one after another, after another, after another, it wouldn't really be bearish if the market needed to pull back into yesterday's range a little bit. It really wouldn't. It would just be that we're very slowly working our way higher. That's all it would be. So intraday, I could be bullish if we do not find support at 54.18, just to come down and test the first week reference at 53.74. I would want to take profits there because there's a very good chance if we don't find support at Friday's high, around 74 is where we will find that support and reverse and come back up. If not, if we got new selling there, I could be bearish for a move down to 53.40. Okay. But then I'd want to take profits. I wouldn't want to stay in it because there's a chance that might be all the market needs to reverse and come back out here. And then lastly, if there's new selling there, I could target a move to 53.26, the very last week reference that is above the balance area high. I know this sounds confusing, but just stick with me here. If we do not find support at Friday's high, if we do not find support at the first repair, the second repair, the third repair has an extremely high probability that that will be all the market needs and it will turn around and head higher from there. So I don't want to be bearish, like as a swing trader, if all the market wants to do today is dip into yesterday's range, squeeze a bunch of stops, and then reverse and head higher. So as long as we stay above that balance area high, as long as we are above 52.88, I am bullish on a longer term basis. Like I'm bullish for the next few days. Okay. But intraday today, I want to see support at one of these levels to go long. Okay. The other idea is if we get a gap and go and the market immediately gets above the overnight high, I could buy that for support. Okay. So you guys know how I feel. I am bullish on today. I think the market is going to go higher. Not just today, but I think in the days ahead, the market is going to continue to go higher. But because we're opening with a gap up, the first move at the opening bell will be down. Okay. So you got to put that in context. You got to think to yourself, if I'm bullish, if I think the market is going to go up over the days ahead, do I really want to short today for a gap fill? Does that really make sense? Or would I rather wait for the market to fill that gap, see the support at yesterday's high, buy that for the next big move the market is going to make? That's sort of the way I'm thinking about things today. Now, as far as upside continuation is concerned, okay, the charts are very messy here. It's hard to get too exact with things. But if we get either a gap and go or a gap fill and go, the first target is this high right here around 55.20. Okay. That is the first target to the upside. We will almost certainly get there if we get momentum up this morning. Once we get up there, we see if we get new buying or not. Remember, this is an old balance area low that was very strong resistance in here just above the high from Thursday of last week. Or sorry, Wednesday of last week. There's a lot of strong resistance. That was a weekly balance area low. So I'm not convinced yet that we can necessarily keep going beyond 55.20 to the upside. But if we get new buying up there, we're then targeting a move all the way up towards that opposite end of balance that the market was in over here. So things could get very bullish with new buying above 55.20 for a move. I would say the first resistance level I'd be watching for is around 56.50. Remember, that is that trend line down on the daily time frame. But if we get through that, all the way up towards 57.70. Okay. One step at a time, one day at a time, one thing at a time. The first order of business is for the market to stay above yesterday's high. So it may open and immediately trade higher. That's bullish. We want to be long. It may open and fill the gap and then turn around. That's bullish. We want to be long. In both those cases, we're targeting a move up here to these highs and monitoring for continuation higher from there. The third scenario is the market comes back down, doesn't find support. We're going short, but only to repair 1 week reference at a time, because any one of these could reverse the market back up and out of here. Any questions on any of that from the chat? If you are hanging out in the Discord and you're watching me there, feel free to jump into the tab that says Futures-Charles, and I will be happy to answer your questions there. Good morning to Doesman, Dan, and Trader. Welcome, welcome. In the chat on the YouTube, we have DNK. Good morning to you. Griff is here. Jay in the house. Good morning, Pirates. Trading. Happy Easter week in the Trading Paradise. Kiwi is here. Good morning to you. He says, can we take a look at Bitcoin? Yes, we will. Trevor is here. Good morning to you. Will in the house. Willie T and DNK. DNK says, yeah, but then a Trump tweet could kill it all. Yes. So that's just the reality we have to live with. that I can't make trades predicting what Trump is going to do. All I can make trades on is what the technical analysis is telling me is the highest probability things to happen. And if Trump tweets and everything changes, I just have to change my analysis at that moment. But I will just say, for what it's worth, I am less worried right now about my bullish stance. I do think, like, the way the market traded on Friday, if it wanted to go lower, at least for now, for this week, if the market wanted to go lower, it had its chance on Friday. So I feel very confident in the technicals that as long as we stay above 52.88, we will get continuation higher this week. Now, of course, that changes if we get below 52.88. Then I change my technical perspective. But unless Trump tweets something crazy or we get below 88, I'm feeling pretty bullish. And I feel like I can trust it. Mike says, do you put together the morning of or hit it Sunday night? So I always do my analysis essentially like 2 minutes before the market opens. Today, obviously, I'm live streaming, so I'm doing it much earlier. But I can look at a chart. I can open up a chart, and within roughly 1 minute to 2 minutes, I can see all the information I need to see. I've just been trading for so long, right? I've stared at the market profile chart so much for so long. I watch it all day, every day. So I just kind of know what the things are, what's happening, and what the levels are. So I can generally look at a chart about a minute or two before the market opens and know exactly what my play is for the day. Am I trying to buy the gap, the gap fill? Am I trying to short to get a gap fill trade? Am I trying to buy the overnight high on a gap and go? Am I trying to wait for a dip? It's like I can make my decisions very, very quickly. And I find it's not helpful to do that on Sunday night because something can happen in between Sunday night and Monday morning that could change everything. If somebody somewhere in the world says something or does something and the market starts to make some huge reaction, that will change what the market is going to do the next day. So I like to just wait until right before the market opens, do my analysis at that moment. Those are the levels I can trust the most. And so, for example, if I had been choosing targets this morning, before I went live, if I'd have been choosing targets to the upside for a long trade, I would have been choosing the overnight high. Well, right now, 13 minutes before the market opens, we're making new overnight highs. So I'd have to change that level as a target to the upside. So if it's better to wait until right before the market opens, then you know exactly what the levels are that you're looking for. Okay. I will just say, for what it's worth, the fact that we're creeping up to the upper end of the overnight range in the last few minutes, that often leads to a gap fill attempt because everyone is long right at that market open. And they're all scared shitless the market is going to fill the gap. So as soon as it starts to, then they all get squeezed. So, You would rather, if you were a bull, you'd rather the market be opening in the middle of that overnight range with a smaller gap. That would be more likely to be a straight gap and go. But I feel like they're getting themselves a little bit too overextended here right before the opening bell. So that will need a bit of a pullback to at least try to fill the gap. All right, let's take a look at the Bitcoin. By request, let's take a look at the Bitcoin. Oh, that's not bad. Broke through some serious downward momentum. So broke through the trend line and essentially turned it into support. I could redraw this now to be like that right there. Bam. Yeah. So Bitcoin's looking bullish to me. Depending on the time frame that you operate on, if you are more of a swing trader here, you got one of two choices. You could long right now, looking for continuation higher. You can wait for a dip down to this sort of 3-day balance we've been in, balance area low, or you could wait for one more test of this trend line to the downside. I would say you have a pretty decent probability of getting a fill at the balance area low, and we'll zoom in a second to get those levels. But you have a pretty good chance of getting a fill there. I don't know that you'll ever get a chance to test this, so just how patient do you want to be? Do you want to miss the trade or do you want to be in it? As far as upside continuation is concerned, it looks to me like we are going to head up and test this resistance above right here around, between 88 and 90. And that will tell the tale for continuation from there. If we get resistance there, we come back down again for this trend line. If we're able to blow through that, we start to head back up for the next major resistance above. So I would say I'm bullish on the corn the way it stands right now. So as far as exact levels are concerned, if you want to buy the balance area low, the 3-day balance area low, that's going to be somewhere around 83,300. That's where you're going to be looking to enter. If you're looking to buy the back test of the trend line down, it's going to be somewhere around 81 is where you'd be looking to enter. And the place to start taking profits is going to be between 87,600 and 88,800. That's going to be a great place to take profits on a long if you're a shorter term trader waiting to see what happens next. Frito in the house. Good morning to you. Dave is here. Good day. Good day, mate. Mike says, gotcha. Ride the wave. Exactly. There is no better way to describe the way I trade than riding the wave. I just want to know what is happening right this minute. And what does that mean is likely to happen an hour from now or a day from now or a week from now based on what's happening right this minute. And then as things change, because they do, minute by minute, things change, I adjust my perspective and obviously my trades. David says, Charles, is it too late to catch the dip? You always say don't catch the falling knife. Wait until the market makes a U-turn. Yes. So again, this is all time frame based. Like, are you talking about as a long-term investor, as a swing trader, as a day trader? So as a day trader, I wouldn't want to go long right now because what is the most likely thing to happen when the opening bell rings? They're going to try to fill the gap. They're going to come down. So why get long now if they might come down, like 60 points, like they could pull back 60 points and it's still bullish. So do I really want to take on that big of a stop or would I rather just wait for a dip to buy? So as a day trader, as far as going long is concerned, there's really only one of 3 ways that I see it happening or one of 4 ways. The first would be the market opens and immediately trades above the overnight high and then it gets new buying up there. Again, I'll be live. I'll talk about it. I will say it when I see it. You will hear the words come out of my mouth That's new buying at the overnight high. I am now bullish. If you hear those words come out of my mouth, it means you can go long because we're getting support above the overnight high, and you don't want to wait around if it's a gap and go. You don't want to waste time, right? You want to get in that trade as soon as possible. So as a day trader, if the market opens, it gets above the overnight high, it's immediately finding support, get long. Even if you get stopped out, it's worth it because that's a great opportunity and a great trade. Now, let's say that doesn't happen. Let's say the market tries to fill the gap. If it can't fill the gap, so if it doesn't quite get to yesterday's high, it finds support somewhere in that overnight range and starts coming back up, I can then go long the market. And again, you will hear me say, I am bullish. This is a gap and go. We are finding support. I will clearly announce that it is bullish before you should be going long. Okay. The third option is the market fills the gap. Okay. And then it finds support somewhere near yesterday's high. It doesn't have to be yesterday's high, exactly, but just somewhere around there. It starts to find support and come back up. That is the gap fill and go long. And again, I will say it. I will announce it as loud as I can that I am bullish and that I think the market is going higher. At that point, you could long for the gap fill and go. To me right now, that's the best entry for a long. Okay. Because as I said, I think they're going to try to fill the gap. And so why get long until they fill the gap, right? That's where the buyers are likely waiting. Now, if you're talking about as a swing trader, okay, did you miss the dip? The answer is potentially yes. Potentially you did. The place to buy as a swing trader, if you were looking to buy, would have been the upper end of Friday's range on Friday. Because again, I'm not saying we're not going to come back down into that today. We might, but I'm just saying in terms of there was a chance when we closed up here near the highs Friday, there was a chance that we could open with a gap up this morning, which we are. And there was a chance that that could become a gap and go, which it could, which could lead us to a move all the way to new all-time highs for all we know. Now, again, I'm not saying that that's what's going to happen. I'm not saying there's a guarantee, but if I'm a swing trader that's trying to get long to target a move, for example, to all-time highs, right? I wouldn't have bought this dip down here because at this point it felt like the market was going to crash and burn. I wouldn't have chased price up here because I would have said we need to come back to back test the balance area high. But after 2 days of grinding on this level and not going lower, somewhere in there would have been the time to say, okay, I'm a swing trader. I want to get long the market. And at the very latest, at the market close on Friday, would have been the time to get long as a swing trader. Now, again, I'm saying that we could still come back down to these lows again. As a matter of fact, the swing low was made in the overnight, which slightly increases the odds that we'll come back for these lows again. Okay. So I'm not saying that we're going to the moon. I'm just saying there is potential for it this morning. There is a potential that we made the low, we back tested the breakout, and now we are in momentum. The train has already started chugging along and it's going. And the longer you wait to take a momentum trade, the shittier the trade is. The worse the potential for success, right? And the less the profits and the more the risk. So if you're a swing trader and you're waiting, Friday was the day to make a decision. So if the market gives you a gift today of coming back down into Friday's range, as a swing trader, remember what I said. It is not bearish to come back in Friday's range as long as we stay above 52.88. So that means it would be a gift to a swing trader if we were to come down here and repair these weak references. It would give them a chance to get into a trade with very little risk and enormous potential reward if it happens today. But I don't think it is. I think we're going to find support at yesterday's high, and then we'll be gone, baby, gone to the upside. Oh, yeah, oh, yeah. Nap in the house, good morning to you. Dave says, would the market not first seek to retest, validate Friday's regular trading hours high before it continues long? So again, yes, anytime you have a gap, there is always a slightly higher probability you'll fill the gap than not fill the gap. Does that make sense? So yes, there is a chance the market will come back to Friday's high. My point is, it has, on a longer time frame, it has already given us the signal. It gave us the signal on Friday that it wants to go higher. So all that a move lower today would be is a buyable dip. It will be a chance for those who didn't have the courage to go long on Friday to be able to buy the market on sale when it comes back into that range today. That's not bearish. Making the market affordable so buyers can buy it is not bearish. What's bearish is when there are no buyers willing to buy it, but there are. They were here on Thursday. They were here on Friday. They were here over the weekend. So there are buyers in this market. The train has already started moving. For those of you that don't know what I'm talking about, if you head to marketsandmind.com, that is markets plural, and mind.com. I teach a workshop. I only do this a couple times a year, and I got one coming up in May. So if you are interested in signing up, you might consider doing that. If you sign up right now, there's a early bird special going on until the end of the month where it's $75 off. And you can use promo code Easter until the end of this weekend to get an extra 20% off. So you can get this $450 course for the low, low price of $300 if you sign up now with the promo code Easter. So again, that is markets, plural, and mind.com. marketsandmind.com. But in this workshop, one of the things that I teach is how you learn to understand momentum. Momentum is the key to success in trading. It is understanding when the market starts to build momentum and when the market runs out of steam, when it no longer has momentum and that momentum is coming to an end. So what I'm describing here is on a swing trade basis. So not like day traders, but swing trade basis. What we did last week was create balance, back test it, and find support. And that increases the odds we are making a large move to the upside this week. Okay? Again, Trump tweets aside, because anything can happen at any moment, this market looks bullish. Intraday today, though, it needs a pullback down towards yesterday's high. All right, the market is open, so let's see what it does. Do we get a gap fill? Do we get a partial gap fill? Or do we just straight up get a gap and go? I will say the current high is weak, as it's the same as the overnight high. So if we start to move down to fill the gap, this is a target for the market to come back up to once it finds support. I'm going to mark 3 different levels here, which are potential support levels. I would want to wait and see if we get support there before I would throw a long order in. Oh, good morning to Pavel, Fibbo from Germany. Welcome, welcome. RK in the house. RK says, swingers banging heads against the table, waiting for a pullback. Like I said, if I was a swing trader who wanted to get long the market, re-entering yesterday's range would be a gift. That's all I'm going to say. It would be a gift because there is a chance we get a gap and go this morning and you don't get back in yesterday's range, in which case, as a swing trader, you're right. You're waiting for the dip and it just doesn't come. And the market just keeps going higher. And then when that happens, what do all those swing traders that are waiting to buy the dip do? They start to chase price, right? They, oh no, I got to get in. And then we get a huge trend day to the upside and wipes everyone out. So if I was a swing trader waiting to get long, it would be a gift to get back inside yesterday's range. Mike says, the taps on the market pulse are giving me fear. Have no fear when the taps are here. It is just a sign that something is happening. Not that anyone needs to panic. Sook in the house, good morning to you. Oh boy, welcome, welcome. Percy in the house. Percy says, hit the like button. Yes, please do. Unless you hate me, unless you think I'm a terrible human being and you want me to feel bad, then don't hit the like button. Just don't hit it. But if you like me, maybe you give me a little thumbs up, a little thumb. Rob in the house. Welcome, welcome. Danny is here. Zach L. says ticks are way overbought. That is generally what you would expect with a gap up. So yeah, as always, when the ticks are way overbought, we don't trust support until those ticks get back to the zero line. They should though, since we're filling the gap. Thank you, RK. Appreciate you. DNK says, come on, gap fill. I'm short from the open. So if they turn the half back into resistance right here, right, like right now, if they turn the half back into resistance, you can take a big deep breath and relax. Because you'll be fine as long as they turn that into resistance right now. We got a question from the Discord. He says, on Friday, could you please repeat the activity that gave you a long bias for the weekend? Did your expectations for volatility change for this week by any chance? For me, the 1 minute ATR in the overnight is the lowest I've seen in a bit. That is not something I pay attention to at all. So I cannot comment on that. But yes, so again, I got it for you to understand why I was bullish at the close Friday. You've got to start by the bigger picture understanding of what the market was doing. So while the market was in here, I was calling it a balance area. To be clear, and I'm not saying this to like brag, I'm saying this for you to understand how technicals work. On the lows on Wednesday, I was bearish, but I was saying if we got above the overnight high, I would be bullish for a move to the opposite end of balance. We got above the overnight high and I got bullish for that move to the opposite end of balance. Now, I could not have predicted that it was going to happen in 2 seconds when Trump, releases this information. I could not have expected that it would keep going beyond that, but I knew the market was in balance. And so I knew if we looked below the balance area low in the overnight, which we did, and we came back up in the regular trading hours, we were heading to the opposite end of balance. That's just understanding balance areas and how they function and where they function. So when I saw the market break higher that day, there was no chance in hell you were getting me long at the highs. I was certain we were coming back to back test that. I then watched that happen on Thursday. And at the close on Thursday, we closed at the balance area high. So, I'm going to mess up my levels here, but that's okay. This is the first potential support here at 54.65. So we'll look for a bounce. If we don't get it, we'll look for another move lower towards 54.31. But yeah, if you look at the close on Thursday, where did the market close? Right at the balance area high. So Thursday, the market didn't tell. It told us we came back for the back test. It told us we spent the whole day going sideways, trying to decide, are we going to go higher? Are we going to go lower? All of that made sense, but it didn't give us a clear sign whether we were going to break one way or the other. So come open on Friday morning, what am I saying to myself? Well, I've got my balance area high and my balance, right here. Do we spend more time above or below that level? Do we bring in more volume above or below that level? And most importantly, do we close away from that level or do we close again right at the same level? We could have had a balanced day where the market went nowhere and then it closed right at the same place as the previous day. But that's not what happened. The market barely spent any time inside that previous balance area. It barely brought in any volume at all. Okay? And it closed all the way up here. So by the market close, I knew we had come back to back test, found support, and we're breaking higher. Okay? So that doesn't guarantee us that we're going to keep going higher and higher, but it does increase the odds that we are because we have momentum up. And so the gap up this morning is another confirmation. Yes, sir, the market is saying we still have momentum up. Now they got themselves a little bit too far, a little bit too fast. So we need a dip to put the market on sale, but we have buyers. Those buyers are just waiting for that discount price and they're going to step in because that's what momentum is. All of this and more in my Mastery of Markets and Minds workshop. I want to teach you to be able to look at the chart and see what I see and think what I think. It's not something I can explain simplistically in an hour. It takes 2 weeks of 4-hour lectures every day to just cover all the material. Now, the good news is when I teach it in the workshop, I give you access to the videos so you can go back and watch them over and over again. So you don't have to absorb it all that quickly, but it takes me that much time to explain it all. Once you've got it in your head, trading becomes much easier because you can understand what otherwise seems random. Right now, if somebody bought the opening price because they were like, look at this massive gap up, there's so much momentum in the market, and they didn't understand that if we start to come down, we squeeze all these buyers, and that gets us a gap fill. If they don't understand that concept of old business and new business, they might have been bullish up here, and now they're getting bearish, right? Instead of the other way around, where you should have been bearish for the pullback and get bullish when we get support. Okay, so we did not get support up here at this node. That increases the odds. We're coming down to this node just above yesterday's high, around 54.31. We will look for a bounce there. If we don't get it, then we're going to look for that gap fill. So whenever I'm looking at the order flow, I'm looking at this heat map right here. For those of you that don't know, everything to the left of this little white line right here, or sorry, everything to the right of the white line, that is the current order book. That is where liquidity is currently sitting in the order books right this minute. Okay. On the left, that is showing you where, based on wherever you are on the time axis, where the liquidity was at that time. So just before the market opened this morning, somebody came in and put a ton of liquidity up here at 55.50. Okay. They also stacked in some liquidity just above price around 5,500. It is not a coincidence that those are round perfect numbers, 5,500 and 55.50. Okay. What they are trying to do is they are trying to scare price away. Essentially, buyers are saying it's not worth going long because there's liquidity just above price and I'm not going to get anything for it. It's going to immediately smack me back down. So that scares price away. Well, what did they just do a few minutes ago with this liquidity up here? They pulled it. They disappeared it. Okay. So that is no longer pushing down on the market. Whenever I see that happen, my instant reaction is to look elsewhere on the chart, because often if they pull liquidity from one place, they will move it somewhere else. So as the liquidity disappears from here, where does it show up at the same time on the same chart? Down here, okay, which is at 25, this node of support right here. Okay, so essentially what they're doing is they're taking away the magnet that is pushing price away up here, and they're putting one down here. So they are trying to stop the market from filling the gap. They wanted to find support and turn around back up through this opening price without filling the gap. So does that mean I don't take a gap fill trade? No, I'd still take a gap fill trade, but I'd just be aware of the information. Seeing those sudden changes when things disappear, and then recognizing where else on the y-axis something changed at that moment will often give you insights as to what the market makers are trying to do. And my guess, to me, this looks like they want to get really close to a gap fill and then reverse it and piss off everyone that's short for the gap fill. Let's see what happens. If you guys remember, Lady D and I both have a rule. If we are targeting a gap fill trade, we will always, always, always put our take profit 1 point above the actual gap fill level, because the market loves to get just almost there and then boop, reverse and just freak everybody out real quick. Now, it will generally come back later and fill it, but it just loves to freak everyone out. And this is what the market feels like it's setting up for right now. It's setting up to almost fill the gap and then squeeze all the sellers who are shorting right now. DNK says, I'm out for 30 points. Got stopped out on the last pullback. That's a great trade. I remember when 30 points was like insane to get in one trade. I would feel like a king of the universe. Now I need like 200 points to feel that same rush. This volatility, man, it's a double-edged sword. It really is. They get you hooked. They get you hooked on that volatility. And you're like, give me those 200-point moves. Floyd's Garage says, really? No, I'm kidding. I'm not actually addicted to large moves. It was a joke. But all good jokes are based on slight reality. It's got to be a little true or it's not funny. All right, so as the market is getting closer and closer to this node of liquidity at 54.25, what is happening to that node? It's getting fatter and fatter. It's getting darker and darker. So as the market is going lower, they're putting more liquidity and more liquidity and more liquidity at this exact level. Why? They're trying to scare price away. They're trying to get it to reverse up out of here. Willie T says the ATR on S&P is 240 today. Yeah, but the volatility has been based on Trump tweets, right? So we can't predict that that's going to keep happening. The current low that we got in the market, the high as well, but the current low is what we call a low volume low. We consider it to be low volume if it is less than 100 contracts at the low of the day, less than 200 contracts if it's inside the range, but less than 100 contracts at the higher the low of the day. That is what we call a low volume low. It just slightly increases the odds the market needs to come back there again. Obviously, we have won on both sides of the market today, which means we'll probably go down and then turn around and come back up, or go up and then turn around and come back down. I love to say weak high, low volume low, chop, chop, chop. The market will go. marketsandmind.com. Okay, if sellers want to remain in control, if they want to try to fill this gap, they're going to want to smack the market down here. They're going to want to turn this half back into resistance. If they start to pass up above 70, what are they going to start doing? They're going to start squeezing the sellers. Anybody that was short down here will start to exit their shorts. And as it goes up, tick for tick for tick, you start squeezing the sellers from up here. So if the sellers want this gap fill, they got to poke it back down right now. Right here, right now, right here, right now. Rob says, what's the idea behind weak highs, poor highs, lows, etc.? Aren't they easier to break that level? Yes. So a weak high or a poor high are basically the same thing. They're just, a weak high is something within the range. A poor high is a high where two TPOs reverse at the same level at the high or the low of the range. So as far as weak and poor is concerned, they're basically the same thing. You know, you don't need to overcomplicate it. And essentially what they are is they are an unfinished auction. That is a way of saying if the market could come back to that level again, there would be somebody there willing to do business. And that's all the market is looking for. The market just wants contracts to trade hands. It doesn't care if those contracts are going long or short. It just wants as many contracts as it can to change hands. So wherever it has momentum, it will often move to the next week reference in that direction. So for example, this morning, what do I think is going to happen? I think the market is going to fill the gap. It's going to find support and it's going to turn around back up out of here. Okay. That's my prediction for the day today. If the market gets back down and it doesn't find support inside yesterday, or I'm sorry, at yesterday's high, Friday's high, it does not find support. It continues down into Friday's range. What is the market telling us? It is telling us we don't have momentum up. We have momentum down. If we have momentum down, it becomes a very high probability that we will repair this, the first week reference inside Friday's range. Okay. Now, do I think at this moment we're going to repair that? No, right? Because the weakness that's jumping out at me right now is the gap. That's the first order of business for the market, is to deal with the gap. And there's a very real possibility, because we have momentum up, that's what the gap up tells us, that there will be buyers waiting here near Friday's highs, right? They've got limit orders right now at this very moment, either sitting in there or icebergs that'll start to fill once we get down there. The market knows there is liquidity if they can fill this gap. But if it finds that liquidity and those buyers are there, it can turn around and start going higher. It doesn't need to come back for this. So the way I think about weak references is, what is the momentum right now, this minute with the market? Okay, I'll assume it's going to repair the first week reference. Okay. That's why I say having a low volume low and a weak high at the same time this morning means we're going to go both ways. It means the market is going to go to one and then reverse and come to the other, or go to the other and then reverse and come back to the one. That's just what it's going to do, because it is weakness on both sides. So we always mark those levels. We keep an eye on them, but we don't obsess over them, because purely having a weak or poor reference doesn't mean the market has to come back to that level. It just increases the odds it will if you have momentum. marketsandmind.com. I'm telling you, if you sign up with promo code Easter, you are never going to get a better deal than you can get right now by signing up for my workshop in May. So it runs from the 12th to the 23rd of May. It is a 4-hour session from 11 a.m. to 3 p.m. each day during that time period. The first half of the lecture is sort of like, traditional college professor style teaching with a PowerPoint lecture. And then the second half is watching live markets and pointing out the things as they're happening in real time. You don't have to watch the lessons live. If you live in a different time zone or you have a regular day job or whatever, you can go back and watch the videos after the fact for up to a year, as much as you'd like. So you don't have to be there to sit and watch them live. And the best part is, this is where it gets cool. I offer a 100% refund, no questions asked, up to 2 days before the course starts. So the day before the course starts is when I send out the email to join the course. So then it's too late. You can't get your money back then. But if you decide by May 10th that you changed your mind and you don't want to take the course, you can get your money back. So to me, if I was in your shoes, if I was losing money as a trader and I'd lost more than $300 in my career in trading, I would be saying to myself, this is an excellent investment. Spending $300 right now to give me the education that could lead to years of profitable trading where I could make millions of dollars is a worthwhile investment. And so if I was going to take the course, I'd sign up right now. I'd head to marketsandmind.com. I'd sign up. I'd use promo code Easter. I'd get in for the cheapest price I could possibly get it. And then I know I still have a month to think about it and make a decision. And I can always change my mind and ask for my money back and you'll get it. So I try to make this as accessible and easy as possible because I do this to try to help traders. And I think a lot of traders, the problem with trading education is a lot of it is horseshit. A lot of it is useless and very expensive. So I tried to do the inverse of that. I tried to create a workshop that is very cheap and very affordable and all encompassing. It is everything you need, from how to read a chart to how to predict price moves, to how to develop trade setups, to how to manage risk, to how to manage your own psychology and your own emotions and your daily routine and habits so that you can be as successful as possible as a trader. I mean, it's all in there. This is like the college course on trading. And right now you can get it for just $300 with promo code Easter. Get after it. Pew, 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 pew. Marketing guy said, trading education deal of a lifetime. There you go. Willers says, I'm reading Jim Dalton's book. Would that fold into your style? 100%. So since the market's just going nowhere, it's just grinding here, waiting to either come down and test the support around 31 or break through the resistance at 72 and head for the opening price. It's waiting to do one of those two. So here's where it's chopping, breaks into support, breaks to open price. Yeah. So my story with trading is I spent probably like 5 years or so just jumping from thing to thing to thing. So like I would find somebody who was teaching how to trade Bitcoin using RSI and MACD. And I would start trading Bitcoin using RSI and MACD. And it would work sometimes and it wouldn't work other times. And I'd get frustrated. And then I'd find somebody who teaches how to trade Forex using Bollinger Bands. And then I'd trade Forex using Bollinger Bands. And it would work sometimes and not other times. And I'd get frustrated. And then I'd move on. And I just kept going from thing to thing to thing and learning all these different things. Until at some point, I basically had a chart with like 20 different things on it. I had VWAP, I had Bollinger Bands, I had RSI and MACD, I had Ikamudu Cloud, I had Hakanashi candles. It was like I had just a fucking mess on my chart, okay? And I was just like looking for this and that and the other. But there was somebody online that I love to follow. The YouTube channel is Shadow Trader, and there's a guy named Peter Resnicek that runs it. And he would do these weekly videos. He still does them. Where he talks about the market and he makes his predictions. And over and over and over again, he would mention Jim Dalton. He was constantly talking about Jim Dalton. I learned this from Jim Dalton that. And then there was another trader who I heard a podcast for named Futures Trader 71, who also just talked about Jim Dalton. So I decided, I was like, all right, I'm going to give this one more try. Because Jim Dalton's courses are very expensive. They're like over $1,000 a course. So I was like, I'm going to give one more trading educator a try, this guy named Jim Dalton. And I took his course and it changed everything for me in my trading. Not because anything he said was all that amazing, but because he helped me to understand that the mistake that I was making as a trader was I was looking for some system. I was thinking there was some system out there. And if I could just learn that system, I'd be a profitable trader. But it didn't work like that. And so a lot of times, sometimes the system would work and other times it wouldn't. The best, consistency I ever had was using VWAP with standard deviations, right? So you would use 1 standard deviation, 2 standard deviations, or 3 standard deviations. And you would, if the market was 1 standard deviation above the VWAP, you would short, targeting to move back to the VWAP using the 2nd standard deviation as your stop, and so on and so forth. And sometimes I would make a killing trading the ES using that system, and other times I would give it all back. Like, I would lose everything, and I could not figure out what are the times where it's going to work and what are the times that it isn't. So anyway, Jim Dalton in his course starts talking about this and how this is the problem that most traders have. They think there's some system out there that they can learn and just do it for the rest of their life. Just do that thing that they've been taught and then they'll just always make money. But that's not how trading actually works. Trading is way more complex than that. That's like saying if you want to be an NBA basketball player, you just have to learn how to dribble and shoot and pass and play defense, and then you're good and you'll be a professional basketball player the rest of your life. No, it's way more complicated than that because of the competitive nature of the game of basketball. there's so many challenges beyond just learning how to dribble a ball. You have to have the skills, the motivation, the opportunity. There's so many other things that play into it. And so he made me understand where I was going wrong with my trading was that I was jumping from system to system to system rather than just picking one thing, one system, and becoming a master at that system. It's as if I wanted to be a professional athlete and I was spending 6 months playing soccer and then 6 months playing basketball and then 6 months playing football and then 6 months playing lacrosse and then 6 months, and I was jumping from thing to thing when instead I should have picked one sport, one job. I am going to be a lineman on the football team and just become the best fucking lineman on planet Earth. Just become really, really obsessively good at one single thing. And that's what changed everything for me in trading. Now, for me, the thing I chose was intraday trading the ES using market profile. So using the auction process and being able to see it in 3 dimensions. Okay, so speaking of which, we just broke through the halfback. That increases the odds that the market will now pass through the opening price. What happens at the opening price will tell us what comes next. So if we get through the opening price and we get new buying, this is a gap and go, and we are as bullish as we can be. If we get a look above and fail, it means we need to come back down for the lows one more time. But this is bullish. This looks like a gap and go. So yeah, what I basically figured out was I got to stop jumping from thing to thing and just become an expert at one thing. So what did I do after I finished my course with Jim Dalton? I got rid of everything. And I literally had nothing but a market profile chart in front of me. And I traded with nothing but the price action. Where does the market go? How much time does it spend at that location? And how much volume does it bring in? And I just spent 6 months obsessively staring at this chart all day, every day, watching every move it made. And suddenly I was able to make predictions about where it would go next. And those predictions had a higher rate of working than not working. And so then I started to find, if I take this trade this certain way, it is profitable. So that was like the first step in the process of becoming a profitable trader. And then reality sets in, which is the uncomfortable truth that so few people are willing to talk about with markets, which is that markets are constantly changing. You don't just learn how to trade and then that's it, and you just do it for the rest of your life. You have to be constantly developing. In the same way that just because you're good enough to get into the pros as a basketball player doesn't mean you're going to be at the top of your game forever. You have to keep up with the competition. You have to keep learning the new things. You have to keep pushing your body to be at your personal best. You have to be able to keep up in a constantly changing environment. That's what trading is. So learning to trade is not like you get some information downloaded into your head and then you just do the job for the rest of your life. Like if you're a plumber, you know what I mean? It's more like being a surgeon where you'll learn how to perform a surgery, but every body that you slice open is slightly different. And there's going to be a slightly different scenario. And you have to think your way through solving the problem each time. That's what trading is. So what I tried to do is, what I believe I successfully did was I created a course to teach that. A course to teach traders how to become a master at whatever is the right approach for them. So step 1 is I teach you how to figure out the approach that's right for you. And then step 2 is I teach you how to develop that over time and build and improve upon it. So no matter how the market changes in the future, no matter how much it changes on a day-to-day basis or over a period of years, you can keep up with the change. You can stay at pro status, at pro level. The only downside is it's fucking hard. So if you're thinking that trading is ever going to be easy, it's never going to be easy. It is always going to be a challenge. It is always going to be like stepping out on the field when you play a sport. It's never easy. It's always hard, but you can win more than you can lose. And that's how you become profitable. And that's how you turn it into a way to make a living. So that's why I recommend the workshop. You bring up Jim Dalton's newest book. I haven't read it yet, but I would say a lot of what you're reading in there will be taught in the course because that was what I started with building out my system. All Jim Dalton teaches in the end is the auction process. He just teaches you how to understand the difference between old business and new business and who does what where. And so when you're watching a chart move and you're starting to think about that, it makes things make sense. So just now I said there's a higher probability we're going to head through the opening price. Why did I say that? Because the sellers were holding the halfback. So you had people going short and going short and going short and going short and going short. So now the old business is short. A majority of participants are short. So if you poke back up through that halfback, what's going to happen to all those shorts? What are they doing right now? They're getting scared. They're covering their shorts, right? Some of them are getting stopped out through hard stops. Some of them are just mentally changing their mind. You also get buyers who are starting to get bullish. That creates momentum and you pass back through the opening price. But then you're in a new location where everything can change, where suddenly sellers could pile on or new buyers could chase. And so you got to wait and see what happens when you get there. And by knowing these locations, knowing what will happen if something breaks and the market starts to make the next move, and knowing what to look for once it starts to make that next move, that is the edge that Jim Dalton teaches. My course will teach you that in depth and so much more and way, way, way more, which is, risk management and position sizing and trade setups and all of that stuff. Okay. Which Jim Dalton does not teach. So if you're a fan of Jim, I'm very confident you'll enjoy the course. And it'll never be cheaper than buying it now with the promo code Easter. Okay, so you guys know how I feel. Bigger picture as a swing trader, I am bullish. I can't tell you right now whether we will fill the gap today or not. I will tell you if we get above the opening price, if we get above 54.95 and we find new buying up there, we will not fill the gap. We will just go up today. Okay, and we will likely have a trend day to the upside, especially since the initial balance is just choppy and sideways. So generally speaking, if you have a tight range for the first hour, whenever it breaks, it gets a bigger move once it breaks. Whereas if you have a large range in the first hour, when it breaks, you often don't get much follow through. Okay. So we have a tight range, which is setting us up for a big move up or down, depending on which way it breaks. So if it gets above that overnight high and it gets new buying, it is very, very, very bullish for continuation higher. If not, if it gets above there and it comes back down, then it's coming back to fill the gap. So if we look above the opening price and we come back through again, then it is definitely going to fill the gap. As far as what happens on the gap fill, again, right now, with the information I have available with me, I assume the buyers are going to step in here, and then the market is going to continue higher and likely close above the opening price. But if we don't find support there, then I change my mind and we target a move down to the first week reference at 53.74. So I am bullish as a swing trader and a day trader as long as we stay above 54.18. With that, I will say goodbye. I wish you all the very best. My apologies to the Bookmap team. It looks like I am stepping into the next time slot a little bit here, but I hope you all enjoyed it. And if you're in the brigade, head on over to the private stream. We will see you there. Thanks a lot, everyone. Bye-bye.